a great pleasure to have Nick Bloom this week. Nick is a professor of economics at Stanford University and a co-director of the Productivity, Innovation, and Entrepreneurship programs at the National Bureau of Economic Research. I was hearing at a previous introduction that someone made about Nick, and they were saying that he doesn't have a field. I don't completely agree. I think he has many fields, but he excels in each field he works on. His research focuses on management practices and uncertainty, and he has been very generous in the sense that he has been collecting data that then he shares with other researchers on these two areas. So if you go to his webpage, you will see that he has some sites to each of these two projects where you will be able to access many resources related both to management practices and uncertainty. He previously worked at the UK Treasury and at McKinsey & Company, and his work has been heavily covered in a range of media, including the New York Times, the Wall Street Journal, the Financial Times, The Economist. He's a fellow of the American Academy of Arts and Sciences and the recipient of numerous awards, including the Alfred Sloan Fellowship, the Bernarder Prize, the EIB Economic Prize, the Frisch Medal that the Economic Society awards to the best paper published every 2 years on work related to uncertainty. And he also was awarded this year with the Kaufman Medal of work related to entrepreneurship and management. He also was awarded the National Science Foundation Career Award. He has a BA from Cambridge and a Master of Philosophy from Oxford and a PhD from the University of College London. So without further ado, let me introduce you to Nicholas Bloom, who will be talking to us about time-varying uncertainty in macro. Thank you, Nick.
Okay, thanks. Thanks very much, Alberto. You always go embarrassed when somebody introduces you like that. As Alberto mentioned, I'm going to talk about time-varying uncertainty in macroeconomics. I'm actually sitting here in Stanford in my office. So if there's one of my colleagues next door is having a very loud phone conversation. So if you hear other voices, it's probably the sound coming through the wall. So I'm going to let's have the slide go down. So this is a topic, uncertainty, which has been a huge resurgence of research since 2008. Interestingly, I was teaching in Chicago about a year ago, in fact, going through slides very similar to what I'm going to talk about today. And Lars Hansen, who in fact just won the Nobel last year, had invited me and was moderating the class. And Lars Hansen and I had this discussion about why there's been such an explosion in research and uncertainty in 2008. So over the last 10 years, suddenly lots and lots of people have started to work on uncertainty. And I think there are three reasons why it's suddenly become a hot topic that I guess Lars Hansen and I came to a conclusion. One is the Great Recession. So I'll show you some data in a bit, but the Great Recession generated a huge spike in uncertainty and it ended the Great Moderation. So the Great Moderation was this period from 1984 to 2007 when there was low macro volatility, and suddenly that's all over. And many people, including many policymakers, and I'll show you some more data in a bit, think uncertainty was a big factor in driving the Great Recession. So I have a quote here. Increased uncertainty is depressing investment by fostering an increasingly widespread wait-and-see attitude. So the FOMC, the committee that was chaired by Alan Greenspan, blamed uncertainty for the Great Recession. So there's been a big policy interest in this over the last 5-7 years, and I'm sure the same is true in Mexico and much of South America. Secondly, interestingly, there's been faster computers. So if you want to run models with uncertainty, you need to model the second moment. it's computationally hard. So people traditionally gave up. If you go back to Kydland and Prescott back in 1982, Time to Build, the paper that won them really the Nobel Prize, they did log linearization. So they assumed that everything was log linear and ignored uncertainty just because it was impossible to do anything else for computers in 1982. Whereas by now we can have complicated advanced models. And then finally there's more data. So I'm going to spend a fair amount of today talking about data. There's much more data to measure uncertainty, so high frequency data. So you can get data every minute now from the New York Stock Exchange, surveys, text search, just a huge amount of information. So I should pause at this point and say, if you have any questions, I have the chat box open. If you want to come up to the mic, that would be great. It's always slightly unusual doing it by webcam, but if you want to ask me anything, please pause, because otherwise I'll eventually get tired. Or even worse, I was given a present. I might start using it, which is a bottle of wine. So if if no one asks any question, I might have to start drinking the wine. So uncertainty's been in the media a lot recently. So I'm going to show you several articles. Here is a piece from the Wall Street Journal. The Wall Street Journal has been running many articles, including some, in fact, this week, arguing that uncertainty is bad for the economy. So here's a piece back from April 2013, so about a year ago, from the head of Vanguard, a massive fund manager in the US, arguing uncertainty slowed down their economy. You can probably hear from my accent I'm English. My wife's actually from Scotland, and next week there's the big independence vote in Scotland. So will Scotland become a different nation? And that's generated masses of uncertainty for Scotland. And in fact, the Wall Street Journal had a piece yesterday, and I was talking to journalists last week about this, arguing this uncertainty for Scotland as being really slowing the economy down. Similar piece, the New York Times argued that uncertainty was causing problems for government. So here it argues that government agencies can't figure out how much money to spend, so they don't know what their budgets are. Here's a piece from the Financial Times over in the UK, my homeland, arguing uncertainty is a problem. Going into Europe, mainland Europe, here's a piece from the OECD that, of course, spans Mexico, much of South America and Asia, and the European Commission arguing uncertainty has been a problem, slowing down the economy there. So a lot of policymakers think it's an issue. For some people, the best evidence uncertainty matters. If you're, for example, John Taylor or John Cochrane or maybe Ken Rogoff, probably the best evidence that uncertainty really matters is that Paul Krugman thinks it doesn't. So some people define what they think is the opposite of Paul Krugman. Paul Krugman, somewhat bizarrely, has argued uncertainty doesn't matter. So he had a series of newspaper articles. Here's one of the early ones, arguing that uncertainty doesn't matter. Here's another piece he wrote in the New York Times, again arguing uncertainty doesn't matter, or that it's effect rather than cause. Paul Krugman, as you know, is not often, it isn't always polite. So he's very direct. And by the third time around, the article was called "Cultures of Fraud," claiming our data and research was terrible. He then called it the uncertainty scam. Another bad story bites the dust. Uncertain at the OECD. What they say versus what they mean. So Paul Krugman has not been super positive. Alberto pointed out I have a draw tool on this. So maybe at this point I can get some revenge on Paul Krugman if I kind of give him a silly haircut or something. But basically Paul Krugman has not been a big fan of this. So today I'm going to discuss 4 areas briefly around uncertainty. I should say this is an updated version of a presentation I gave at the Society of Economic Dynamics in the summer. I gave a keynote address, so every day they have one big address, and I went through this. So this is a summary of the literature. There are 4 things I want to talk about. One is theory. So what's the theory in uncertainty? It's generally in good shape. I would say it's reasonably clear what the predictions are from each theory, but there are actually a lot of different models. Most people know Dixit and Pindyke or real options, but turns out there are maybe 8 or 9 models of uncertainty. I'll go through them very briefly as what they are. There's then measurement. How do you measure uncertainty? Uncertainty, is in my mind. It's what I'm uncertain about the future. So it's actually very hard to measure this. So we have a lot of proxies, things that suggest what uncertainty is, but no direct measures, and I'll talk through these. Then identification. So a big challenge is causality. So what causes what? Paul Krugman's critique of the literature is uncertainty isn't causing the recession, but instead the recession is causing uncertainty. So he has the causality going in the reverse direction. That's definitely a concern, and I'll talk about that. And then finally, future work. What are the issues? In particular, let's get this thing out of the way. What are the issues? Measurement, identification, and computation. So what's the theory? There are, in order to get uncertainty mattering, you need curvature. So if you're in a linear world, there's no role for uncertainty. So for example, if we look at the utility function here, it's linear. Utility equals A plus B, C. So you can use expected values of C. So if you have linearity, uncertainty doesn't matter, so you need non-linearity. And this is important because if you look at, I mentioned earlier, Kidlin and Prescott's Nobel Prize-winning paper, the Real Business Cycles paper, in 1982, they used log linearization. So everything was linear. Therefore, in these basic or maybe standard business cycle models, often uncertainty doesn't matter that much because to approximate things, we've used linearization. So in the early literature, uncertainty played little role. So that's one reason why it's been ignored. And suddenly, recently, people have thought uncertainty matters. It's a huge policy question. It's a big empirical question. And suddenly we've gone from no research on it to an explosion now of research on uncertainty. So there's a range of different theories. I've sorted them out into 2 groups. Whether uncertainty is, weird with the webcam. So whether uncertainty is negative at the top, so that it's bad for growth, whether uncertainty is positive at the bottom, so good for growth. Most people assume that all the theories about negative effects, there are some positive channels, and I'll very quickly summarize all of them and then spend a bit more time talking about the first one, adjustment costs or real options, which is the one most people know about. So starting with real options or adjustment costs, I'll go through them. So in adjustment costs, the idea here is that it's expensive to hire or fire. So when you're uncertain, you become more cautious and you slow investing and you slow hiring. I'll talk more about that in a minute. A second source of curvature comes from utility functions, so risk aversion. So the idea here is you're risk averse. When uncertainty goes up, you don't want to invest as much. So that's a very old idea going back at least to Tobin and probably back to Keynes. More uncertainty makes borrowing costs higher and people are less likely to invest. A third model, there's been a lot of these literature on this recently. It talks about financial frictions. So for example, Simon Gilchrist has some papers with Egon Zachariach and Eric Sims, Jay Sims, Ariana Bai Keyhole. There's a number of different papers, Larry Cristiano and Marty Eichenbaum, the Motto Regano. There's several papers on this, argue that when it's costly to go bankrupt because of a lump sum cost, financial frictions can reduce growth. And then finally, there's a slightly different angle around what's called ambiguity. So Martin Schneider and Cosmin Iluk have papers whereby they argue that if you're ambiguous and you're ambiguity averse, if you're ambiguity averse, you don't like uncertainty, and they model that as being very pessimistic. So if you always think the worst outcome is going to happen, and you have this spread of events, you always think the worst outcome is going to happen. If a mean preserving spread happens, but you always think the worst outcome is going to happen, you become even more pessimistic and you reduce investment. So those are, 4 uncertainty negative models. There's also two positive channels. One is a long literature called the Oy-Hartman-Abel effect. So Walter Oy wrote about this in it was Econometrica in 1961. Richard Hartman in the RE Stud in 72 and Andy Abel in the AER in 83 argued that when there's a lot of volatility, firms can choose, and by re-optimizing, they can end up increasing output. It's kind of like reallocation in a sense. It allows for more reallocation. The other literature is around bankruptcy and what's called growth options. So here the idea is it's very Silicon Valley. So Stanford is sitting out in Silicon Valley in the middle of, the computer world. And the idea around growth options is somebody comes out with a new exciting technology. I guess, the iPhone 6, I think it is being unveiled literally right now. So a new technology. That's maybe not so new, but you can think of a new technology like the internet or the cloud maybe when they were early on. If you have bankruptcy, you can have a lower bound at zero. So if the lower bound is always capped at zero, if uncertainty increases, the outcomes go up, but the lower bound is still zero, and the upper bound gets better and better. So if the worst case scenario is zero, you maybe want more uncertainty because it increases your best case scenario. And that's what people thought about the internet. We're so uncertain, but if the internet has the better the upper bound is, the more I want to invest. So I can see Alberto is typing. So I'll read out the question. So to analyze uncertainty, we need to know that the third derivative of U of C and log linear models completely remove those terms. But I understand that work as the one developed by Juan Rubio Ramirez and co-authors is trying to deal with it. How promising do you think that route is? That's a great point. So there is, in fact, there's the Spanish co-authors or Spanish-speaking co-authors, Jesus Fernandez Villaverde, in fact, my co-author, Juan Rubio Ramirez, Martin Uribe, and Pablo Guerra, have a paper in the American Economic Review, and they get uncertainty into models, and they get it through a channel I don't really have here, actually, so I guess you could have it as an extra channel, whereby there is some curvature, and in fact it's curvature in pricing. So in their models, the way it works is firms set a price. They have pricing adjustment costs. So I guess you could think of it as an adjustment cost channel. They have a pricing. They have sticky prices. Now, if you set prices too high, so imagine here's your optimal price. If you set prices too high, you make a loss of this size. When prices are high, you don't sell many units, so your loss isn't scaled up by that much output. If you set prices too low, you still have this loss, but now you're selling a lot of output, and so your total loss is this loss times many, many units, and so you actually lose more absolute revenue. So they argue that, exactly as you put risk matters, they argue that when uncertainty is higher, risk is important, and it leads firms to cut prices, to put up prices, be conservative, and that leads to inflation. The other channel in the Risk Matters paper, in the AR, so I'm getting the papers slightly confused. So the AR paper called Risk Matters looks at open economies, and here it's the risk aversion channel. So they argue that, for example, I think Ecuador is in their data set, I think Brazil, Mexico, I can't remember, but they argue in small open economies, when uncertainty goes up, money flies abroad. So Ecuador, you're uncertain. People don't want to invest in Ecuador. They want to invest abroad, and that kills the domestic economy. Argentina, yes, so Argentina is another one. So they argue that there's definitely risk aversion. Unlike America, which people model as a closed economy, when you have open economies, when people are risky, they park their money abroad. So the reason this isn't as obvious as it seems, because in Argentina, it makes a lot of sense. If you're uncertain, the money goes abroad, say it goes to America, and Argentina gets depressed. In America, you think of America as more as a closed economy, and if risk goes up in these models, on the one hand, consumers want to save more. On the other hand, the thing they want to save in capitals become more uncertain. But net, these things roughly cancel out. And the reason you don't obviously get this big negative is money can't go abroad. So in America, if you're risk averse, these basic business cycle models assume you have to invest the money domestically, whereas in Argentina you model it as an open economy and you think you can invest the money overseas. So this is definitely a complicated area in terms of the theory. There are very many mechanisms going on. You're right, risk is one, in sticky price. In the what are they called? New Keynesian models, you get this stagflation effect from prices. I'm going to, let's see, go back to here. I'm going to focus on adjustment costs as probably the most well-known mechanism, and it's kind of uncertainty effects 101. This literature goes back, in fact, to some character you've probably heard of called Ben Bernanke. Interestingly, Ben Bernanke's PhD thesis that he published while he was at Stanford, so he was also at Stanford for a while. One of his key papers was called Uncertainty, Irreversibility in Business Cycles, and it came out in the QJE in 1983, and it talked about how uncertainty can generate recessions. So Ben Bernanke's PhD is very much on this topic. McDonald and Siegel, Bertola, Bentalila, Dixon, Pindup, many people have work on real options. So the idea here is that investment and hiring decisions are irreversible. So if you invest, buy a new factory, you change your mind, it's very expensive to sell it off. If you go out and hire someone, you have to spend a lot of time and money training them up, and it's impossible to get that money back if you fire them. And it was the idea behind my 2009 paper, The Impact of Uncertainty Shocks, which I did in micro to macro and partial equilibrium. And to talk about this, I'm going to summarize a paper I have with Max Floetotto, Nia Jaimovich, Itai Saporta, and Stephen Terry that we're in fact revising for Econometrica right now. So the idea here is, in fact, reasonably straightforward. So there's a production function, and in firm J in time t is a function of aggregate productivity, so A. This is the thing that if you're a real business cycle guy, you would argue drives the economy. Then there's idiosyncratic productivity shock, Z, for firm J in time t. Then there's capital, standard, labor, standard. So that's kind of a standard Cobb-Douglas production function, except we now have this idiosyncratic shocks. We also assume aggregate and idiosyncratic productivity follows an AR1 process. So again, this looks kind of like Kidden and Prescott, real business cycles, or much of the New Keynesian models in the TFP part. So aggregate productivity is autoregressive. It's a function of lag productivity with this AR term plus some kind of shocks. Idiosyncratic productivity is autoregressive, again with some shocks. The key thing that's different here, which I think is on the next slide, that's it, is these shock terms here have subscript T. So in a normal real business cycle model, you just have aggregate productivity shocks, and sigma here would not have a time subscript. So sigma is like constant all the time. In these models here, there's time variation in sigma. So sometimes it's high, sometimes it's low, sometimes it's high, sometimes it's low. So uncertainty varies over time. And it means when sigma is high, uncertainty is very high. If you're forecasting against the future, you're uncertain, and volatility will be high next period. If sigma is low, the same is true in reverse. So in this model, we have them as two-point processes. There's either high uncertainty or there's low uncertainty. When it's high, both sigma A and sigma Z are high, so both micro and macro uncertainty are high just because that's what we see in the data. And when it's low, both micro and macro uncertainty are low. So that's the stochastic environment. First moment shocks from A and Z, second moment shock from sigma A, sigma Z. What about capital and labor? That's kind of standard. So capital equals depreciated capital plus investment. Labor equals depreciated or attrited labor plus hiring. This turns out to be really important because in these models, if you don't invest at all, so if you set I to be 0, you don't hire, so you set S to be 0, the capital and labor force next period is going to be lower because depreciation and attrition. So for example, depreciation, we think this delta K is about 10% a year. So that's about 2.5% every quarter. So if no one in the economy invests, capital stock will be about 2.5% lower next quarter. So that's a huge drop. If the capital stock drops by 2.5%, that's a big drop. Moving on to labor, we normally think that labor attrition rates are more like 20%. So about 20% of employees leave firms every year. They leave because of maternity leave, they get sick, they retire, they go back to college. A lot of reasons why people exogenously leave. In the US, that number is more like 25 to 30% in normal times, kind of 20% in recessions. So again, that means if you don't hire for one quarter, nobody hires, the labor force drops by 5%, which is a huge drop. So in all models, actually doing nothing is very powerful. If you don't invest and you don't hire, you get a big drop in output. Let's go down a slide. We allow for adjustment costs. So investment and hiring have lumpy costs. Every time you invest, you have to pay a fixed cost. For example, years ago I worked in McKinsey. I worked in my last job was working in McKinsey retail, actually working in gas stations, helping them to improve sales, and they reconstructed the gas station. They decided to change the layout, and they got contractors in to rebuild them. And there was a fixed cost, so the gas station closed down for 2 weeks. You can't have customers come in while you're doing construction work, so all sales stopped. There's what's called a partial reversibility. So all of the old equipment they ripped out, they couldn't use, they couldn't sell it really. Some stuff they could sell, but they'd maybe get 25 cents in the dollar. So there's a big adjustment cost. So these are both collectively called non-convex adjustment costs, and they're there for investment as they are for hiring. So when you hire people, you have a hiring committee. If you think of a university, however many people we hire, we have to put out an advert, we have a hiring committee, we go to the AEA, and every time you hire a person, you also have some hiring costs. So what you get from these kind of models is that you get what's called SS bands. So SS bands come from the upper bound, the big S, is the investment threshold. The lower bound, the small s, is called the disinvestment threshold. I've ranked the economy in terms of productivity over capital. So you have a high level of productivity, you're going to be towards the right, you're wanting to invest. You have a high level of capital, that pushes that down, you're going to be to the left, you want to disinvest. And here's the density of units in the economy just after shocks have happened. So guys, if you're sitting here and you got a positive productivity shock, it moves you to the right. If you're sitting here, you have a negative shock, it moves you to the left. This thing is rightward skewed, and the reason is productivity tends to rise slowly over time. It's upward productivity growth. Capital tends to fall slowly over time. Both of these tend to shift density slowly to the right. What we see here is that to the right of this threshold, these firms in the economy are investing. These guys to the left are disinvesting, so their productivity is so bad and their capital stock so high, they want to get rid of capital. These guys, productivity or demand, you can also exchange this word productivity for demand conditions. It doesn't really matter. So demand or productivity are so good, they have so little capital, they're investing. Then in the middle, there's a large period of inaction. So why are these guys doing nothing? Well, it's expensive to hire and fire, therefore conditions aren't quite good enough to invest, but conditions aren't quite bad enough to disinvest. So you have a lot of investment, a little bit of disinvestment, and that's where we are. Now imagine uncertainty goes up. That pushes the investment threshold out to the right. It pushes the disinvestment threshold out to the left. What does that do to our economy? Well, it kills investment. So this entire area is the drop in investment. That's pretty big. This entire area is the drop in disinvestment. That's pretty small. So net, overall investment falls because now you're not keeping up with productivity growth or capital depreciation. So at an aggregate level, uncertainty goes up, the thresholds move out, and you see investment would suddenly drop. So that's what I'm going to call the delay effect. So higher uncertainty leads firms to postpone decisions so that net investment and hiring both fall. And with a slight abuse of mathematical notation. DI with respect to D sigma is less than 0. So I is investment and hiring, sigma is uncertainty. The derivative of these is negative. That seems kind of obvious. Uncertainty goes up, investment and hiring go down. So that's the kind of obvious prediction. The other thing that's less obvious, I'll talk about in a minute, is called the caution effect. So imagine you're the Fed or the Bank of Mexico or the Chilean central bank, and you want to stimulate the economy, or you're Barack Obama, you want to stimulate the economy. How might you do that? Well, you might cut taxes, cut interest rates. Who will that impact? Well, at low uncertainty, this height of units here, this density height here, are the firms that are marginal in investing. So if you just cut interest rates by epsilon or cut tax rates, this height here is likely to invest. They're the marginal guys. Now, imagine uncertainty goes high. Here's where the investment threshold is. Now, here are your marginal guys. Hardly anyone. So what's going on is in normal times, you have this height. That's kind of the elasticity of investment with respect to, say, interest rates. When uncertainty is high, you have this much smaller height here. So basically, when uncertainty is high, the economy is much less responsive to interest rates, to taxes, to any kind of price taxes or policy stimulus. So in a sense, it's a perfect storm. Uncertainty goes up, then the economy does badly. As a central bank, you want to intervene by cutting interest rates, but now you push the lever to change interest rates and nothing really happens. This is called the caution effect in the literature. Here it's a second derivative. So the derivative of investment with respect to A, so that's prices, TFP, interest rates, anything you want, any stimulus, is lower when uncertainty is high. So there's delay effect. Uncertainty directly reduces investment, but there's also the caution effect, which it makes investment and hiring less responsive to anything. So that's productivity, but also policy stimulus. And in fact, this model that in the paper has two dimensions. So there's actually capital and labor, two factors. So you actually get a two-dimensional box. Here's a zone of inaction. Here you're hiring. This is productivity over labor. This axis is productivity over capital. So here you're investing. Here you've got a lot of high productivity to capital. Here you have high productivity to labor. Up here you're hiring and investing. Down here you're firing and disinvesting. And here's this period of inaction. And low uncertainty is in red. If uncertainty goes up, the thresholds move up to black. It doesn't look like a big difference, but it is, because depreciation and attrition means most of the economy is here. So most of the economy is at this threshold. They're hiring and investing. Uncertainty suddenly goes up, and these guys are now doing nothing. So uncertainty goes up. You have a drop in hiring, a drop in investment, and a drop in responsiveness. So here's what you'd see in aggregate. An uncertainty shock causes an output drop of about 3.5% and a recovery to level within about a year. So these are big. So I got a question. So just for clarification, the model doesn't include human capital. No. So great question. It doesn't. So we go up here. The model has two factors, physical capital and labor. You could think of labor as including human capital. And in fact, what drives the model is that there are adjustment costs, and these are likely to be much higher for highly skilled employees. So the evidence, interestingly, in the US is that labor adjustment costs are rising over time. So if you look at labor markets, churn. So my co-author Steve Davis has been looking at labor churn, and this has been gradually declining over time because human capital is going up. People are more skilled, and they're more expensive to hire and fire. You could think of other types of capital in this model. So there's intangible capital. I actually have a paper in the AAR, paper in proceedings, talking about R&D capital, computer capital, human capital, anything else that has adjustment costs is likely, when uncertainty goes up, to pause. So when uncertainty goes up, you may think R&D investment pauses, IT investment pauses, skills pause. So Alberto asked, is this related to the types of risk shots Larry Cristiano has been proposing? So the answer is yes, mostly. So it's a kind of qualified yes. So if I go back here, there are many different models that argue uncertainty matters. So if I'm going up, I'm going to go back a stage. So I've been talking about theory. There are various channels in the theory for uncertainty to matter. So if I have a black box, I have uncertainty comes in, and then I care about, it's slightly odd with the webcam. Everything I do left to right reverses. So I'm sorry my hand movements aren't very good. But if I have theory, I have a black box, an uncertainty shock hits the economy. The theory explains why it matters. In a bit, I'm going to talk about how we measure it, what's causality in future work. In the theory, Larry Cristiano has slightly different underlying mechanisms. He relies more on financial frictions, some utility functions, depends exactly on his paper. I've tended to rely more on adjustment costs. But at the bigger picture, we're both saying the same thing. So we both have papers saying uncertainty matters. We have slightly different mechanisms, but a similar underlying idea that uncertainty goes up and it reduces. Larry's paper, which I like a lot, it's come out in the AR, one of his papers, has financial frictions interacting with uncertainty, but you can get it through many channels. So somebody else asked, I'm going to go back to this earlier question. It's a great question. So would structural reforms reduce the effect of uncertainty? And the answer is yes. So if you lowered hiring and firing adjustment costs, it should make the impact of uncertainty lower. You're exactly right. And the reason is, if it's very expensive to hire and fire, so I can think of France, firms are incredibly reluctant to invest and hire people. So in fact, one of the arguments that's been raised about why France and Europe in general has had such a bad recovery is that uncertainty is high and they have very high adjustment costs. So lowering adjustment costs, and it's easier to do through the labor market, is going to reduce the impact of uncertainty. That's right. I'm sorry, I'm reading out another question. It says, variations in sigma, wouldn't they imply variation risk other than uncertainty? So I mean changes in the dispersion of a known distribution. So this is a great question, and I think I may skip ahead. I'm going to pause, in fact. So I think it's Banco de Guatemala. So I'm guessing that's the Guatemalan Central Bank. So the difference in risk and uncertainty is a great question. I'll come back to it in a minute. So you're right. There are two, in the theory literature, there are two different concepts. In practice, I think they're close to being the same. So conceptually, they're different, and I'll come back with an example. In practice, they're very similar. But it's an important issue. So why don't I finish the theory? So here we go. I think I can skip to my slide just to check where I was. Yeah, so here was where I was at earlier. So unless you already know, you may well know I'm the referee. I probably shouldn't say that, but it's a published paper. Yeah, all of these papers are published papers. Since I worked on uncertainty, I get asked to referee everything on uncertainty. Well, not everything, but a lot of stuff on uncertainty. I mean, I think it matters a lot. If you look at citation ratios, publication rates, presentation of uncertainty, it's exploding. So in fact, if you're interested, there is an MBR conference in 2 weeks. I could look. I'm not going to move to my email to check, but I'm co-organizing this with Xavier Gabex. It's called an MBR Universities Research Conference. In fact, anyone is welcome to attend. So if you have the resources and money to fly to the MBR, please come along. It's open. Most MBR events, like the Summer Institute and the winter and fall conferences, are invitation only. this is not. So, in fact, it's called the University's Research Conference. And I think the web address is, in fact, why don't I try and pull this up now? See if I can. I think it's www.nber.org/tilde-conf. Let's see if I can get this to work. Yeah. So this address, I'm going to put it into the browser. But I have to log in from Stanford, so it's slightly slow. This conference in, where is it? Okay, so go to this address. So here, if I type it in. So that address down below is something called the NBR University's Research Conference. It's on Friday the 19th of September. Unlike every other NBR conference, it's open. So if you'd like to come along, you're welcome to come along. I think you have to email Rob Shannon or the NBR, but it's an open conference. That's actually what's called University's Research Conference. It has a lot of papers as well. You can download them. That shows you this is a very active research agenda. The NBR has one University's Research Conference every year on what it deems to be a hot topic. Jim Peterba picks the topic, and this year he picked uncertainty. So feel free to look at that. So coming back to this, uncertainty generates a drop in output. Why is that? Well, when uncertainty goes up, people pause hiring and they pause investing. That's kind of obvious. The other thing so this is obvious from the theory. The other thing they do is they actually pause reallocation. So we know from the work of John Holtuanger, Steve Davis, Eric Bartlesman, many people, that a lot of productivity growth in the US is driven by reallocation. So productive plants expand, unproductive plants contract. Net, that increases average productivity. In this model, the same thing is going on. So plants are getting high productivity shocks, are growing. Plants are getting low productivity shocks, are shrinking. When uncertainty goes up, these SS bands move out and everyone pauses. And if everyone pauses, reallocation also pauses. So in this model, actually, hiring stops, investment stops, but also productivity growth pauses. So there are three drivers: hiring, investment, and productivity growth. And when all three of them drop, of course, output drops. So this looks a lot like a real business cycle recession, apart from productivity growth dropping as an outcome rather than the driver. So if you're Killen and Prescott, you have productivity shocks drop output. In my model, uncertainty drops output, and it leads to a drop in productivity growth. Then uncertainty drops back down. There's pent-up demand for hiring and investment, and people get back to hiring and investing. So they pause. The economy, drops for a bit, and then it recovers. So it's a pretty big drop, but it doesn't last that long. So you get short, sharp shocks. You don't get very long recessions of the type we saw in 2008, 2009. So to get a Great Recession, uncertainty was definitely a driver of the Great Recession. My guess is it drove about a third of it. But you also need something else like financial meltdown or negative productivity shocks. Let's go down a page. So if we look at what's going on underneath, you can see labor drops and recovers. That's the delay effect. People pause hiring. Investment drops and recovers. That's the delay effect. People pause investing. And solar residual or productivity growth goes negative, then recovers. This is a caution effect. So in this period here, productive firms are not really expanding very much. Unproductive firms are not really shrinking very much. Since we've detrended productivity growth, that generates a drop. So Juan asks, does it matter if uncertainty comes from changes in demand or from supply, and how's that related to causality? Again, an important question. In these models are sufficiently simple. Going back to, let's see, so here we go. So in these models, these things here, A and Z, are actually called business conditions, and they would combine the supply and demand. So actually in the paper we explicitly write down a Cobb-Douglas production function, the productivity shock, and a demand shock. In practice, I think it's a bit of both. My sense is a lot of the uncertainty in the Great Recession has been demand uncertainty, particularly at the micro level. So I think they both matter. They're both going to have similar impacts, though, on aggregate outcome. Whatever uncertainty's sources, supply or demand, it's likely to generate a drop in recovery. Alberto asked another important question. So in these models, uncertainty should be fast. Uncertainty should be fast. Recovery should be fast. The answer is yes. So if you just have an uncertainty shock, recovery should be fast. So you should not get a jobless recovery. So that's correct. In practice, uncertainty shocks, A, seem to last. Uncertainty seems to last for a while. And B, it's also accompanied by a first moment shock. And what seems to happen is the caution effect is maybe one reason when you also have a first moment shock generating a jobless recovery. So I'm going to come back to this a bit later on, but it looks like recessions are combinations of an uncertainty shock and also a first moment shock. So both the first and second moment. So there's negative first moment, so demand and productivity go down, and a positive second moment shock, so uncertainty goes up, and collectively they drive the recession. So I put in the slide how general are these results. They're reasonably general. I'm kind of moving ahead, so I ran out of time, but real options require certain conditions. You can wait. So if you can never wait, for example, you're in a patent race or an auction, there's no ability to delay. Point two is slightly technical, but you need either decreasing returns to scale or imperfect competition. If you have both perfect competition and constant returns to scale, you can invest now and invest later. It doesn't matter. There's no choice. You do both or neither. You can also require you're able to act rapidly. If there's a big delay after you invest after you make a decision, so there's heavy time to build, you can get these things called put options. There's an old paper in the AER that I didn't referee, but I was in completing grad school about here. So Barlan and Strange have a paper in the AER arguing that if you have these big time to build delays, you can get a positive effect of uncertainty. And finally, you need what's called non-convex adjustment costs. So if you only have quadratic smooth adjustment costs, you don't tend to get an effect. But empirically, that doesn't appear to be very realistic. What about measurement? So this goes back to what's called the question from Guatemala. I'm sorry I don't have your name, or Baco maybe. So the literature on uncertainty rolls together uncertainty and risk together, but they're actually theoretically distinct concepts. So Frank Knight, the brilliant Chicago statistician and economist, actually talked about two different things. So he talked about risk, which he defined as a known probability distribution over events. So here I have a British coin, 2 pence piece. So if I flip this British coin, it's a 50% chance it's heads, it's 50% chance it's tails. So it's a known probability distribution. It's risky, but it's not in some senses uncertain. Knight defined uncertainty as an unknown probability distribution. So a good example here will be the number of coins ever produced by mankind since 2000 BC. I mean, in some senses, that's a ridiculous question. And my guess is somebody somewhere in Stanford's archaeology department might know that answer, but I certainly don't. I doubt anyone in the room does. The number of coins ever minted, you'd have to think of every civilization and every coin. I mean, it's impossible. I have no idea what that distribution is. So I would have 90 in uncertainty over the distribution of number of coins. In practice, these concepts are pretty linked. I think the real world is somewhere in between both. People have to make decisions. They have to come to probability distributions. Even after 9/11, stock markets in Europe continued trading, so people had distributions. So I'm going to ignore this difference and call everything uncertainty for practical purposes. But if you're a kind of purist, you certainly may get worried. What I'm talking about in my model is risk, but I'm naming it uncertainty. But in some sense, it's just kind of a practical thing that the real world thinks of this as uncertainty. So I'm going to call what formerly Knight would call risk, I call it uncertainty. So how do we measure it? Well, there are a number of proxies, number of stylized facts. So one stylized fact, macro uncertainty appears to be counter-cyclical. It rises in recessions. So here's a measure of uncertainty from stock market volatility, you can see mostly it goes up in recessions. So in the most recent recession, stock markets were incredibly volatile. They were in 2000s. It's not always the case. So this is Black Monday, 1987. There was a big spike in volatility. There was almost a recession in the US. So growth dropped for 1 quarter, but not 2. So it wasn't formally defined as a recession. But typically in recession, stock market volatility goes up. So that's one measure. Another measure, so stock market volatility is realized. In a sense, a better measure is forward-looking. We want to know what's in people's minds, what they're thinking about the future. And the perfect measure, really, for theory is what's called the VIX. This is the 1 month ahead implied volatility in the S&P 500. How do they get that? Well, they look at a basket of put and call options trading on the Chicago Board of Options and Exchange. And if you know the price of the put and call option, how long they last for, the strike price, the current price, and the maturity or the duration, you can invert it to get what's called implied volatility. They do that for a bunch of options. And this is implied vol on the S&P 500. It's 1 month ahead. You notice this only goes up to 1990 because we don't have implied vol before then. But over the last 3 recessions, this has clearly risen in every recession. So implied volatility, kind of my favorite measure, and what I used in my 2009 paper, which is 1 month ahead forward-looking uncertainty also rises in recessions. So that's kind of the, I would say it is an industry standard measure of uncertainty, a most commonly used measure. This will be at the VIX. Both stock volatility and the VIX both kind of lead and lag the cycle. So this is a slightly complicated figure. Here I've shown volatility, or sorry, the correlation of stock volatility in blue and the VIX in red with monthly industrial production growth. And here I've shown it in the number of months that the stock vol and the VIX lead, and here is lag the cycle. So in 0, what we can see here, what does this number here mean? This negative minus 0.25. So the VIX has a correlation contemporaneously with industrial production growth of about minus 1/4. This number here says the VIX has a correlation of about minus 1/4 3 months ahead of industrial production growth. So the VIX is forward-looking for industrial production growth. And what you can see is from about 3 months out, 3 months ahead, the VIX starts to rise as the stock market volatility ahead of a drop in industrial production growth. So in this sense, it leads the cycle. These are measures you can get real time. So not surprisingly, the Fed and hedge funds and investment banks and everyone else that wants to predict the economy is very closely looking at the VIX and stock market volatility because they're a big predictor of recessions. It's also the case that they appear to rise to some extent after the recession. So they kind of rise, but they're negatively correlated after. And coming back to what I'll talk about in the next session, cause and effect, it looks like 2 things are going on. 1, uncertainty causes recessions, but 2, recessions themselves make uncertainty worse. So you have a cause and effect, a kind of a loop cycle going on. Uncertainty goes up, recession gets bad, therefore uncertainty goes up higher, therefore recession gets worse. And we seem to see this in the data. What about so here, I put this slide in. I was actually interviewed by Goldman Sachs 2-3 months ago to talk about a topic that I don't know if it's on your mind, but certainly it's a big issue to the markets, which is volatility is actually now at very low levels. So if you look at the VIX, it's around 15. It's incredibly low, and markets are saying, why is volatility so low? Uncertainty appears high, and there's a big debate. Nobody agrees on it, but I should say that just empirically, vol is quite low, and it's concerning people like Goldman Sachs, concerning them enough to have had one of their partners interviewed me and wrote up a piece that I talked to them to. Marcus Brunemar talked to them. A few other people actually talked to them. It's only, by the way, that stock market volatility that's low. Other measures of volatility like news coverage and forecast disagreement aren't so low. So stock markets are calm, but the economy in general, bizarrely, is not quite as certain. Another measure is looking at newspapers. So I've been doing a lot of work recently trying to search for newspapers. So one measure is to look at 10, for example, the 10 leading US newspapers Boston Globe, New York Times, Chicago Tribune, etc., and search for the frequency of news articles that have the word economy or economics, so econ on star, and uncertainty or uncertainty, etc. We do this, and this is what you get for the US. It actually looks pretty sensible. Newspapers, you may worry about what they're publishing, but we've been doing a lot of work on it, and in general, newspapers actually seem to be sensible gauges of uncertainty. So after Black Monday, stock market was very volatile. There was a spike in uncertainty. The newspapers are talking more about economic uncertainty after the first Gulf War, so Saddam Hussein invades, going all the way through to 9/11, and most recently the meltdown. So here you can see the recession has been accompanied from 2008 to about 2013 to a big increase in newspaper coverage of uncertainty. And I should say this measure, we've actually, Steve Davis, Scott Baker, and I have been posting it at this website, www.policyuncertainty.com. It's been used a lot now by banks, hedge funds, trading houses, Federal Reserve boards, etc. Actually, Bloomberg has included it in their terminals. It's part of Fred, it's part of Haver, it's part of Reuters, so it's very widely used, and it seems to be a good measure for predicting credit spreads, for predicting the economy. Why is this happening? Well, the nice thing about newspapers is you can break them down in a bit more detail. Interestingly, in the US, if you look at why there's been the rise recently, it's driven heavily actually by just policy uncertainty. So this is policy uncertainty in particular. There's a lot of discussion about taxes and healthcare. So in the US, there's enormous concern about what's going to happen to the budget, a lot of discussion about the Affordable Care Act. Monetary policy and national security haven't seen rises in uncertainty. National security is maybe not that surprising, at least until recently. The US was in relative calm. If you compare it to, 08 to 012 was a relatively calm period. This was periods of Gulf Wars 1 and 2, 9/11, Afghanistan. Now, there is military action going on, but it's less. Monetary policy has been low because in America, inflation rates are stable, they're low, and interest rates are low and stable. So for newspapers and for the common man out there, there isn't that much monetary policy uncertainty. So this is kind of why newspapers are interesting. Wall Street, or the stock market's obsessed with quantitative easing, tapering, etc., but Main Street, as in newspapers in the US, are not. So I think newspapers give you a helpful, different perspective from looking at stock markets. Policy uncertainty also leads and lags the cycle. Here's a parallelogram again. You can see policy uncertainty in the newspapers appears to go up, or uncertainty in newspaper reports goes up in advance of the recession, but also lags it a bit. So again, it's a useful indicator. Looking at newspapers is a useful predictor of the state of the economy going forwards. We've also taken this measure back in time. So here it goes back to 1900. You can see the big spike around the Great Depression in the US. So it's not just currently it's risen, but the Great Depression, a huge increase in policy uncertainty, particularly under Roosevelt. There's also been a more secular increase in policy uncertainty over time and economic uncertainty over time. It's not clear why that is. We're looking at it, but it's an interesting research question. Here we have data for Europe. We've looked at 10 European newspapers, El País, El Mundo, etc., down to FAZ in Germany. Europe looks similar, but it has its own movements: Nice Treaty, Treaty of Recession. It ran up recently in the recession. Here's India. India has quite a large free press, so we've looked at 7 Indian newspapers. Goes up and down. Here's China. China does not have any free newspapers, but something called the South China Morning Post that operates out of Hong Kong appears to be reasonably independent. We have newspaper coverage for China. Here's a policy uncertainty index for China. We're right now producing one for Russia, trying to figure out how much policy uncertainty is going up in Russia thanks to Ukrainian crisis. Russia has one free newspaper, Kommersant, which we're using. Somebody asked, have you looked at the correlation of credit and money in long time series? So partly. So it's interesting. So again, a great question. I'll give you 2 answers. So one is related. So it's certainly true that our measure of uncertainty is very correlated with financial conditions. So Mark Watson and Jim Stock had a piece in the Brookings papers in 2012 trying to look at what caused the Great Recession in the US, and they argued that policy uncertainty and a measure of financial, Gilchrist and et al.'s measure of financial conditions was so highly correlated it was hard to tell them apart. It's also the case that I know a lot of the banks and hedge funds are using our policy uncertainty or economic uncertainty news measures to price credit spreads. So interestingly, we've spoken to a lot of guys up in Wall Street and the guys in Chicago, the traders, who've said we traditionally use the VIX and stock market volatility to price credit spreads. So how much should junk bonds, how much higher should the interest rate, say, on junk bonds or triple B be on, say, triple A? I don't know Mexico's sovereign debt, but I'm guessing it's probably not triple A. The US isn't even triple A anymore, and I don't think Britain is either. But so the cost of downgrades, they've been using our measure to price that, because they claim stock market volatility is so absurdly low that it doesn't reflect real market conditions. At least some people claim that. So there are definitely correlations, but I haven't done that much. I haven't done a huge amount. One of the things that's interesting about this area is the literature is wide open. So there's a lot of questions that they don't have research on. So I can't answer every question, in part because much of this stuff has come out over the last 5 years. I mean, this data I'm showing you now is from a paper that's not even published, not even a working paper. We don't have an MBL working paper on this yet. Not every country can we get data on. So North Korea, we do not have a policy uncertainty index for North Korea. You can't trust anything out of North Korea. I was told a fantastic story a couple of weeks ago that apparently North Korea, in their last election, the newspapers published the results of the election the day before the election was held. So you can tell how rigged it is. All we know from North Korea is pictures of huge military parade. So you do need a free press to do policy uncertainty indices. I mean, South America has that, and Central America. We have been looking at, along with the IMF, but doing stuff around Brazil, Argentina, Mexico. I think we'll have some indices hopefully shortly. It's not that hard. You pull together newspapers, you search them, a frequency of sensible words. So I'll be happy to talk to people that are interested in expanding this. Another thing you can look at is forecasted disagreement. So the Philadelphia Federal Reserve Bank has a number of surveys. It has about 40 surveys a quarter from guys like JP Morgan, Merrill Lynch, Goldman Sachs. And it asks them to forecast the future of the economy. And if you look at when they disagree, going back to 1992, you can see they tended to disagree a lot in the recession. So people generally tend to think of disagreement as a measure of uncertainty, although theoretically it doesn't need to be. There's another better measure called forecaster uncertainty, which is they ask these guys to put their forecasts in bins, like the probability of GDP growth being of less than 2.5%, of 2.5 to -1 to -1 to 0 to 0 to 1.5 to 1.5 to 2. And that gets you a histogram over this distribution. And that generates forecasted level uncertainty. And here's the average. This also seemed to go up in the recession. And here's the mean forecast in green. So forecasted disagreement, forecaster uncertainty seems to rise. Here's another measure from another paper that's R&R of the AAR. Econometric forecast uncertainty also seems to rise in recessions. So macro uncertainty goes up. What about micro uncertainty? Well, this also appears to be counter-cyclical. In our theory, in the really uncertain business cycles, we talked about this idiosyncratic productivity. Well, I'm going to show you graphs showing industry, firm, plant, and even product or price level idiosyncratic productivity uncertainty appeared to go up. So here's industry data. Here are growth dispersions. It's from about 200 monthly manufacturing industries in the US. Here's the 91st percentile, here's the 99th. What you see is, in recessions, this growth spread goes out a lot. Goes out every recession, it appears to blow out. And these growth rates are very hard to forecast. So if you use various forecast models, you really can't predict them. So it suggests industry uncertainty goes up in recessions. Here's something similar for firms. It's the interquartile range of the growth rate of all CompuStat firms quarterly. And the interquartile range goes up a lot in recessions. So in recessions, the top guys have a lot bigger gap between them and the bottom guys. Here's within two-digit industry, it kind of looks similar. So even within relatively narrowly defined industries, growth dispersion across firms goes up a lot in recessions. So this is a kind of a cross-sectional spread. Some firms are doing really well, some firms are doing very badly. The time series, the macro is that the macro series is going up and down. The idiosyncratic is across industries, across firms, across plants, and across prices. It seems to become more dispersed. Here is plants. So in red, in black, here's the non-recessionary growth rates on average in the U.S. census. U.S. annual survey of manufacturing is about 15,000 plants that we have this data for. Here's the recession years. The growth rate is clearly lower, so the first moment's negative, but the second moment is higher. It's about 150% higher variance. So it's hugely uncertain, so much more volatility at the plant level. Finally, prices, all the way down to prices. For reasons that, again, aren't obvious, prices are even much more volatile in recession. So this comes from Joe Vavra's QJE paper. Here's the IQR of price changes. They go up in recessions. So first stylized fact is macro volatility is higher in recession, so macro time series is more volatile. Second stylized fact is that there's a more dispersion across industries, plants, firms, and prices. Third stylized fact is that higher moments, so skewness and kurtosis, appear not to be countercyclical. I'm not going to go through this in detail, but if you look at the standard deviation of TFP shocks, it appears to rise in recessions. This is what this positive significant coefficient shows. If you look at skewness and kurtosis, it's not much evidence it goes up, to be honest. So it looks like here's the normal distribution of TFP shocks on the left. Going to recession, the first moment goes down, but the second moment goes up. So recessions are periods of negative first moment shocks and positive second moment shocks. I'll skip this. There's some debate whether that's true in income data, but I'm going to skip this. Finally, it's also true that uncertainty is higher in developing countries. So if you split countries by having more or less GDP per capita than $20,000 in 2010, lower income countries tend to have just more dispersed GDP than high income. Maybe not surprising, but volatility is typically higher. So someone says, Alberto, why are the differences in performance at the micro level? For example, Gilchrist and I have a paper showing during recessions, firms have more price elastic firm growth gain market share. The answer is, to be honest, I don't know. So, economists rarely say this, but why industries, firms, plants, and products have more dispersions at micro level is not obvious. It's a question that I'm looking at to some extent. I don't have a great answer for you right now. Other people are also looking at. There's a number of theories I'll come on to at the end. I don't know. So there's a bunch of theories about endogenous uncertainty, about some industries get hit differently than others. You could probably come up with many good explanations. I'd say none of them are kind of the silver bullet right now. So uncertainty is higher. So what about identification? So there's a big question in this literature, what causes what? So the focus of my theory, well, not so much theory, I guess my work has been uncertainty causing recessions. So the arrow of causation goes from uncertainty to recessions, but there's also a reverse model. Maybe recessions cause uncertainty. So maybe, it's the reverse. Recessions happen, uncertainty goes up. Is this plausible? Well, yes, there are definitely good reasons to worry about reverse causality. My favorite or least favorite person, Paul Krugman, his newspaper articles are exactly on that. So Paul Krugman argued that, look, what happened in the recession is times got bad, governments were desperate to change, so they did TARP, they did they did the stimulus package, they did QE 1, 2, and 3. They basically try everything. So if times are bad, you want to try lots of policy, and it generates lots of uncertainties. This is a story of entirely reverse causality, and it's what Pastor and Veronese have a paper on. There's another story, there's another flavor of stories. So Fagelbaum, Schall, and Taschereau Dumichel have a paper, Doedinger, Van Nieuwenberg, and Velkamp, arguing that learning matters. So when uncertainty, activity generates learning. So when you go out and invest and hire, that generates learning, and when the economy slows down, learning slows down. There's another set of theories around experimentation. So Bachman and Moscarini argue in recessions it's cheap to experiment, therefore it's a good time, that generates uncertainty. And Orlick and Velkamp argue recessions impede forecasting, and that again makes uncertainty higher. So there are various reasons to worry about reverse causality. So what does the data say? Being, I guess I'm slightly more of an empirical than a theory guy. I've shown you a lot of theories arguing that uncertainty causes recessions. I've just discussed briefly some theories arguing the reverse, that recessions cause uncertainty. What do we know from the data? The data is frankly a bit of a mess. It's not conclusive. Uncertainty leads and lags the cycle. We don't really have any great natural experiments. I'll tell you what we have, but I should say at this point it's a bit of an open question. So there's micro papers. Leahy and Whitehead's a classic paper in '96. I have something in the RE stud in 2007. We use general method of moments. Basically use lags. You look at lags of uncertainty to find out whether it predicts current investment. This data seems to say there is a causal negative effect of uncertainty on investment, but it's not ideal because you're using lags as instruments. So some weak micro evidence. So I'm going to pause. There's a question, again, interesting question. So have we ever thought of the balance sheet effects of micro and macro uncertainty and how they differ across countries? In the absence of imperfections in financial markets, micro uncertainty should disappear. So yes, so definitely. So if you go back to the theory, so there's several different lines of theory here. So the types of theory that rely on risk, so in particular consumer risk, or some of them involve firm risk. So managers of firms are also risk averse. They're not perfectly diversified. In this situation, you may think that if it's just micro uncertainty, you can diversify against this. So in some senses, Silicon Valley is super risky. Every startup, internet startup, is incredibly risky, but money's flooding in. Why? Because we're diversified. On the other hand, macro uncertainty is something that you can't diversify. So on the risk front, you're right, that's likely to be much more damaging. On real options, it's not really, it's uncertainty about looking at the future, and it's a real effect that doesn't really get affected by diversification. So for the risk channels, yes, I think micro versus macro is going to matter. For real options, it doesn't really matter. For some of the other channels, so I'm trying to get I'm used to using my hands when I present. It's slightly odd. Everything's reversed here, but for the other channels, it depends on a case-by-case basis. So in the models I've looked at, micro versus macro are not that important a distinction. That's real options, but in risk models, definitely it does matter, and that is important. And it is going to matter very much by country. So in the Risk Matters AR paper, macro uncertainty drove everything. Micro uncertainty wouldn't really matter because you could diversify nationally. So what about other papers? There's macro papers. Ramey and Ramey have an old famous AER showing that growth is lower and volatility is higher. Engel and Rangel have a paper, showing a similar thing, updating it more sophisticated. Rob Engel, who won the Nobel Prize, not surprisingly, more sophisticated econometrics, similar result. And again, you worry about causality. One approach I've done is look at first moment shocks, so things like the Cuban Missile Crisis, 9/11, etc., exogenous big shocks. I tend to find a big negative effect of uncertainty in recovery. There are problems about controlling for the first moment, but it's suggestive there is a big negative effect of uncertainty. Another approach is to use micro variation in terms of exposure. So Luke Stein and Liz Stone had a paper looking at micro exposure of firms to energy and exchange rate uncertainty. I've had stuff looking at policy uncertainty. Again, we seem to find some causal effect, but I'd say it's not conclusive. So in summary, the literature is suggestive of a negative impact on uncertainty, but it's definitely not definitive. And my honest view is uncertainty is a cause and effect. So I think the truth is there's some big shock happens, like an oil shock or a 9/11 or a housing crash. This combines, so the shock itself is both the first moment shock, bad news, and a positive second moment shock, increased uncertainty. So think about 9/11. So 9/11 was firstly bad news, but secondly increased uncertainty a lot. So they both happen at the same time. So you have both shocks occurring. And then as the recession progresses, you get this kind of vicious cycle that uncertainty increases as the economy collapses, but pushes up uncertainty, etc. So overall, there's this feedback effect, and uncertainty is both an impulse and also an amplification and propagation mechanism. So it has multiple effects. So finally, what about future work? There's a wide range of open questions: measurement, impact, I've talked about cause and effect, mechanisms, there are many theory channels which matter most, also computation. So the thresholds for computational work have advanced a lot recently, and that's a great area to be working in. I'm going to talk about one, which is firm level surveys. I've been working with the Atlanta Federal Reserve Bank and the census to try and ask questions about uncertainty on a firm by firm basis. So we've been piloting on a few hundred firms. In fact, now it's up to a few thousand. Questions like this: projecting ahead over the next 12 months, please provide the approximate percentage change in your firm's sales level. And we ask about the lowest case, the low, the medium, the high, and the highest case. And across the 300 firms that have responded so far, the lowest is -9, the low is -3, 3, 9, and 15. So that looks kind of sensible. You may wonder why we use these kind of vague words like lowest, low, medium, high, highest. And the reason is that we initially tried using precise bins. So it'd say, what's the probability of growth is less than -2.5%, 2.5 to 1, 1 to 0, 1 to 2, 2 to 2.5. But the problem is firms have hugely varied growth rates. So some guys, like Silicon Valley guys, are growing at plus 50% a year. Others, tobacco companies or coal firms are growing at -30%. So it was too broad to have an explicit bin. So we went for implicit lowest, low, medium, high, highest. What do we see? Well, here are the distributions of their actual answers for the 300 firms for the lowest, low, medium, high, highest. You can see this is about -10 on average, about -3, 0, kind of +2, +10. There's a big spread. There are guys reporting -30 down here and guys reporting +50 up there. Looks pretty sensible. We also ask about percentage likelihoods. So we say the follow-up question, please assign a percentage likelihood to those sales level changes you selected above, and they give us about 10, 20, 40, 20, 10 to those lowest, low, medium, high, highest. So kind of normal distribution. Again, looks pretty sensible. Here are the distribution of outcomes. They put most weight on the medium case, least on the tail of cases, but we're getting a normal spread. So this has been great. We've done this for the Atlanta Fed. We've asked about sales, about investment, about hiring, profit margins, prices, cost margins. We're getting very sensible answers. Starting to use that to generate firms' expectational views of uncertainty. I think this will be an important step going forward to try and get proper measure of uncertainty and do it on a regular basis. And if anyone in any of the central banks in South or Central America is interested in doing this for your own country, let me know. We've just started in the US. We've just been piloting it. In fact, I was out in Florida 2 weeks ago testing it, visiting firms and running these questions, and they seem to work well. If you're interested in reading further, I have a paper in the Journal of Economic Perspectives that just came out earlier this year, so in 2014, that summarizes this in a pretty easy to digest way and has further readings. and I'm preparing a more lengthy tone, a longer piece if you ever have problems sleeping at night. So a survey with Jesus Fernandez-Villaverde and Martin Schneider. So thanks very much, and feel free to ask any questions. Sorry, go ahead.
Thank you very much, Nick. So the work that you are doing with the Federal Reserve Bank of Atlanta is intended to be a panel, is that right?
Yes. So they have a fantastic setup. They call it the decision maker panel, or decision maker survey actually, and they've recruited by now about 2,000, I think, or 1,500 respondents that they send an email to every week to fill out the survey. Now, this email is incredibly short. It only asks, we actually rotate the questions every other month. We ask 3 of them, a bunch, with 6 one month and 6 the next. So they've timed it. It takes about 3 or 4 minutes. They follow up with this panel. So they've been sending them at Christmas to send them a Christmas card. They send them a mug. We're going to send them Stanford hats and T-shirts. But yes, the idea is to ask. We randomize. We have an A and B version. We randomly each month ask one set the A and one set the B, and therefore we have a monthly time series. In fact, the plan is now to move it to do a quarter every week to get a weekly data set, because we've got enough variation. Somebody also asked the reference for the JL paper. It has not yet come out, and I don't think. Do I have a draft? I'm just looking at my website. I'm not sure I got the draft on my website because it's so messy. I don't think I have it up here. It's like a horrible mess. So for now, I would read the JEP piece. The JEP piece is pretty good. Oh, it's there. Okay, great. You know my website, but okay. So this JL thing is a bit of a mess, but it's getting worked on. Okay, thank you, Alberto. The JB piece, I actually prefer. I worked on it. I mean, so far I prefer it because the JL piece is yet to be pulled together. JP is very recent. I finished doing it at the end only about 9 months ago, and it has a lot of references. So I'd start from there. It's pretty easy to read as well.
Any other question? If not, we'll thank our speaker today, Nick Bloom, for this very broad and interesting presentation.
Now I get to drink this.
Well, I think it is too early. It is 10:30 your time.
That's true. Although being British, yeah, you are right. In fact, I'm about to head to the census census note here to tediously look over data. Although that's maybe a good reason to have some wine.
Okay. Well, thank you very much for all the attendees, and I would like to remind you next week, Tuesday is a holiday in Mexico and some parts of the continent, mainly in Central America, for Independence Day. So we'll move the seminar to Wednesday, where we'll have Enrique Mendoza. The seminar will be at a different time. It will be Wednesday, September 17 at 2 p.m. U.S. Eastern Standard Time. And well, remember that the schedule is available at SEMLA's website, and we'll be adding a couple of other webinars for the next 2 months, and then we'll make a close November 4th. Thank you very much, Nick, and thank you very much to everyone.
It's great.
Wow.